Welcome to the debate. Here's a pretty brutal reality. 97% of day traders actually lose money.
Right, it is a staggering failure rate.
Yeah, it really is. Yet, millions of retail investors wake up every morning, read the financial news, and try to beat the market anyway.
They certainly do. So today we are asking a simple question. Is acting on daily financial news an actual legitimate way to build wealth?
Or is it just a psychological trap designed to separate you from your money? I am arguing that markets incorporate new information almost instantly. So active retail trading based on the daily news cycle is a behavioral hazard. It mathematically destroys wealth.
With, emotional intelligence and strict discipline can actually capitalize on mispriced assets.
At its core, my position relies on the efficient market hypothesis, or EMH.
Which is a brilliant theory on paper.
Well, it is more than just paper. The theory posits that asset prices fully reflect all available information.
Right.
The direct implication is that you cannot consistently beat the market on a risk-adjusted basis.
Because market prices only react to new, unpredictable information.
Exactly. To understand the sheer statistical reality of this, we just need to look at the comprehensive data on Taiwanese day traders.
The failure rates in that data are stark. I will gladly concede that.
Stark is almost an understatement. The researchers tracked all trading activity over an extended period. Active traders underperformed a valuated market index by 10.3% annually.
Wow. 10.3%.
Every single year.
And for our listeners, a valuated market index is essentially just a benchmark, right, where companies are represented based on their total market size.
Right, exactly.
It acts as a proxy for just owning the entire broader market passively.
Spot on. So if you just bought the whole market and did nothing, you would be 10.3% wealthier every single year compared to these active traders. Net of trading fees, 97% of them lose money. This strongly suggests retail trading is driven by overconfidence, not any real informational advantage. The math points to passive, long-term asset allocation as the only rational approach.
I will give you the point on the failure rates. But perfect market efficiency is, it is a theoretical construct. It completely fails to account for human nature. The market is driven by emotion, which creates clear, exploitable anomalies.
Okay, what kind of anomalies?
Consider the research on Indian equity markets. It analyzed how retail investors react to algorithmic financial news headlines, specifically those AI-curated summaries pushed directly to mobile trading apps.
Oh, the ones designed to trigger an immediate reaction on your phone?
Exactly. The data demonstrated that positive headlines inducing massive herd behavior. People experience familiarity bias. They see a brand name they recognize in a positive light, it feels safe, and they buy without ever looking at the actual valuation or the underlying balance sheet.
Wait, so what happens with the negative headlines?
They trigger profound loss aversion. Neurologically, the pain of losing $100 registers about twice as intensely as the joy of making $100.
Right, that makes sense.
So when a negative headline hits, people don't just objectively evaluate the news. They feel a physical urgency to stop the pain. This leads to indiscriminate panic selling. These emotional overreactions entirely invalidate the idea of perfect, instantaneous market efficiency. They provide a quantifiable edge for investors who maintain strict emotional discipline while the rest of the market panics.
That assumes the market gives you time to react. The idea that you can just exploit an emotional overreaction, it relies on a misunderstanding of how quickly information is priced in. A recent experiment with German retail investors perfectly illustrates this.
Oh, how did they test it?
The researchers gave non-professionals hypothetical news reports, some positive, some negative, and they asked them what would happen to a $1,000 investment a month after the news broke.
Okay, and what did they say?
The vast majority believed the stock would continue to rise on month-old positive news. They fell victim to recency bias.
Meaning their brains just drew a straight line pointing up into the future based on past events?
Right. They expected what just happened to keep happening forever. They failed to understand that after a full month, the price is already adjusted. The expectations are entirely baked into the cost of the stock.
But you're assuming the price adjustment happens accurately.
I see why you think that, but let me give you a different perspective. Comparing retail news trading to finding an edge is like placing a bet on a horse race after the horses have already crossed the finish line.
That is a bold claim.
The odds have already adjusted. By the time the news reaches your phone, institutional money is traded on it. They move the price until the information is completely wrung dry of any trading value. Think about the forward earnings ratio. You know, the price you pay today for $1 of profit the company might make next year. If a company announces a new product, that ratio instantly skyrockets. To make a return, the company doesn't just have to succeed, it has to exceed those newly elevated expectations just to keep its stock price stable. Retail investors reading the news are participating in an illusion of advantage.
Well, I come at it from a different way. That horse race analogy assumes the finish line is a fixed objective reality.
Isn't it?
In finance, the spectators' reactions keep moving the finish line. Let's look at Chinese retail market dynamics. The Chinese stock market is uniquely retail-driven. They have over 200 million individual investors, accounting for the majority of trading activity.
Wait, 200 million? So it is heavily retail, quite unlike the institutionally driven U.S. market.
Exactly. And these investors rely heavily on social platforms like Snowball, Douyin, and WeChat. What happens is you get a culture of herd investing and survivorship bias built around viral stock gods.
Let's clarify survivorship bias for a second because it is crucial here. Survivorship bias is when we only focus on the winners who got lucky, while completely ignoring the thousands of people who went bankrupt making the exact same trades.
Right, you log onto a social platform, see 5 traders bragging about their massive returns, and the algorithm hides the 50,000 users who lost their life savings. The survivors are visible, the failures are invisible.
Yeah, it creates a warped reality.
And because of this environment, when sudden state-led regulatory interventions happen, like restrictions on the technology or gaming sectors, investors lose their perceived behavioral control. They panic.
So they abandon independent analysis and just rely on the crowd?
Precisely. This means the initial price adjustment is almost always wrong. It is driven by fear of missing out or panic selling. Prices do not instantly reach a rational equilibrium. They overshoot. A disciplined retail investor who understands this behavioral contagion can wait for the overshoot and take the counter position. The market isn't perfectly efficient. It is emotionally volatile.
You're assuming a human has the time to spot that mispricing window. But they don't. And that is because we aren't trading against other humans anymore. We are trading against high-frequency trading algorithms, or HFTs.
The algorithms certainly dominate the volume.
They dictate the reality of the market. Institutional HFTs use ultra-fast computers to execute thousands of trades in, milliseconds. That is a timescale before a human neuron can even fire.
Yeah, the speed is hard to even conceptualize.
Exactly. The European Securities and Markets Authority notes that while HFT provides market liquidity, a lot of it is what we call ghost liquidity.
The vanishing orders.
Right. Imagine you are trying to buy a house. You walk up, see the for sale sign, and make an offer. But the seller is a supercomputer. In the millisecond before your offer actually registers, the computer sees your intent to buy, cancels the listing, and instantly relists the house for $1,000 more.
Ouch.
That is ghost liquidity. The algorithms flash large buy and sell orders to test the market. But the moment a human retail trader tries to interact with those orders, they vanish. By the time a human reads a headline, decides this is an overreaction, and clicks buy, the algorithms have already extracted all the value.
That is a great analogy, and I acknowledge the speed of HFTs. But those algorithms themselves cause market instability, which creates the very anomalies retail can exploit. We have seen this repeatedly. Look at the 2010 Dow Jones flash crash.
Where the market lost nearly $1 trillion in minutes.
Yes, high-frequency trading exacerbated the crash. The algorithm saw prices drop, so they rapidly withdrew their liquidity, creating a total vacuum.
Right.
Other algorithms saw the vacuum and aggressively sold into it, magnifying a cascading effect that wiped out $1 trillion before a swift recovery. We saw similar sudden drops with the British pound in 2016. The reactive nature of HFT algorithms creates blind feedback loops. They accelerate price declines without evaluating the underlying assets.
But if the algorithms are moving the market by $1 trillion in minutes, how does a retail investor sitting at their laptop survive that? You are describing a battlefield where retail traders are completely outgunned.
Think of high-frequency trading algorithms like high-speed trains. A retail investor should not step onto the tracks and try to outrun them. That is a guaranteed way to get crushed. Instead, the disciplined retail trader waits safely at the station.
Okay, walk me through what waiting at the station actually looks like in practice.
It means knowing these algorithms thrive in volatile conditions and exacerbate price swings. So the strategy is defensive. You utilize limit orders rather than market orders. A market order just accepts whatever the going rate is, which during a flash crash might execute at a fraction of a penny instead of $50. A limit order ensures your trade only executes at your exact desired price. You avoid trading during highly volatile windows, such as the exact minute a major economic report is released. You let the algorithms cause the predictable overreaction, let the high-speed train pass, and then step in to pick up the mispriced assets left in its wake.
I hear the mechanics of waiting at the station, but human psychology drives people onto the tracks.
It is a temptation, sure.
I am not convinced by that line of reasoning because it requires a level of psychological fortitude that the data proves retail investors simply do not possess.
What does the data say?
74% of day trading volume comes from traders with absolutely no history of success.
Which is staggering. But why do they keep trading?
Because of present bias. Present bias is our brain's tendency to prioritize instant gratification. You know, the quick dopamine hit of a winning trade today over long-term goals like saving for retirement over 30 years.
Right, they want the quick win.
They fall into emotional traps like greed, fear, and revenge trading. When a stock soars, a scarcity mindset and anchoring bias trigger a fear of missing out. They anchor their expectations to the stock's highest price and buy at the absolute peak.
And when it drops, loss aversion kicks in and they panic sell.
Exactly. And then you combine that with the Dunning-Kruger effect, the illusion of competence. It is a cognitive bias where people with limited knowledge overestimate their own expertise. Someone reads 2 articles on semiconductor manufacturing, makes a lucky trade during a broader market rally, and suddenly their brain tricks them into believing they are a financial genius. They are inherently wired to fail.
I understand why those psychological traps seem insurmountable. That is a compelling argument. But have you considered that those traps are precisely what allow the disciplined minority to succeed?
How do you mean?
The fact that the majority fail doesn't mean the activity is impossible. It merely proves that the true edge lies in psychological discipline rather than pure informational speed. The research on Chinese retail investors actually proves that emotional intelligence positively impacts investment decisions.
But emotional intelligence is a personality trait, and when you are up against machines designed to exploit human hesitation, a personality trait is not enough to protect your wealth.
It becomes a strategy when you systemize it. The framework for overcoming these emotional traps is highly documented. To combat the fear of missing out, you cap your weekly trades to avoid impulsive moves. To combat panic selling, you diligently journal every trade.
Journaling sounds pretty passive. How does that create an actual edge?
Because you force yourself to analyze your own mind. You know whether the entry was based on structural analysis or fear. You use pre-trade checklists. Before executing a buy order, the trader must literally check off criteria. Is this trade based on structural analysis or fear? Am I chasing a green candle? Where is my exact exit point if this goes against me?
That takes intense discipline.
It does. And to prevent revenge trading, that entitlement bias where you feel the market owes you your money back after a loss, you force a mandatory break from the screen. The individuals who trading with this level of rigid, systematic discipline are the ones who capitalize on the mistakes of the 74% who are trading on pure emotion.
Let's look at the scale of the problem, though. If 97% of day traders are losing money net of fees, then the system you are describing is a needle in a haystack. For every one person meticulously maintaining a trade journal and executing limit orders with zero emotion, there are 99 people letting their present bias destroy their savings.
That may be true.
The financial literature is clear. People knowingly bear losses they did not anticipate because stories of successful day traders circulate in non-representative proportions. The entire retail active trading industry is built on monetizing this overconfidence. Therefore, telling retail investors they can find an edge through discipline is essentially selling them a lottery ticket wrapped in self-help rhetoric.
It is not a lottery ticket. A lottery is purely random. The market is not random. It is an aggregation of human behavior, which is highly predictable in its irrationality. Yes, the algorithmic delivery of financial news is designed to maximize engagement rather than provide balanced information. We see this with AI-curated headlines that amplify emotional responses, but awareness of this mechanism is exactly what provides the advantage.
How so?
If you know that a negative headline is engineered to trigger loss aversion in the masses, you can objectively evaluate the underlying business metrics of the company. Does this news actually threaten the company's long-term viability, or is it just a temporary narrative? If it is a narrative, the resulting sell-off is an opportunity. The edge is not about processing information faster than a machine. It is about processing the human reaction to that information better than the crowd.
But processing that reaction still requires time in the market. Let's return to the German study on recency bias. Retail investors struggle immensely to separate current news from future trajectory. If a company announces terrible earnings, the stock drops. The disciplined investor you describe steps in to buy the dip, assuming it is just an emotional overreaction from the crowd.
Buying the panic.
Right, but what if it isn't an overreaction? What if the core business is genuinely failing? This ties into discounted cash flows. That is the core of mathematical valuation. You sit down, estimate every dollar a business will generate from now until eternity, and calculate what those dollars are worth today, factoring in inflation and risk.
Sure.
If the new data shows the company will make less money, the efficient market hypothesis suggests the new, lower price is an entirely rational valuation.
You are saying the market priced the danger correctly.
Exactly. By stepping in to buy, your disciplined retail trader is just catching a falling knife. They are grabbing onto an asset that is dropping for a very good reason and getting sliced in the process. They are substituting the crowd's emotional panic with their own confirmation bias, convincing themselves they see an overreaction where none exists.
Catching a falling knife is certainly a risk, which is why risk management, like strict position sizing and avoiding concentration in a single asset, is paramount. But let's look at the alternative you are proposing. You are suggesting that because the market is overwhelmingly efficient, investors should only passively allocate their capital into broad index funds.
That is what the mathematics support for the vast majority of people.
Well, that is a sound strategy for the majority. It completely ignores the structural inefficiencies we have discussed. When the Chinese government unexpectedly announces new regulations and an entire sector drops by 30% in 2 days, that is not an efficient market rationally calculating future discounted cash flows. That is a collective panic attack. To claim that a retail investor with capital, patience, and a pre-trade checklist cannot profit from a collective panic attack is to deny the basic reality of behavioral finance.
I do not deny behavioral finance at all. In fact, I am leaning heavily on it to prove why retail traders lose. The very biases you mentioned, herd behavior, overconfidence, loss aversion, are the reasons why active trading is hazardous to wealth. You are arguing that a tiny fraction of people can rise above human nature. I am arguing that standard financial advice must be based on statistical reality, not the exceptional outlier. The statistical reality is that trading actively on news destroys wealth.
And I am arguing that financial education, rather than paternalistic restriction, is the answer. If we understand that fintech platforms and algorithmic news reinforce these biases, the solution is not to tell everyone to give up and buy an index fund, The solution is to teach emotional intelligence. Teach investors how to recognize algorithmic manipulation. Teach them about the danger of relying on opinion leaders on platforms like Douyin. If we acknowledge that the market is a psychological arena, we can train people to compete in it defensively and profitably.
We have covered a lot of ground today, and I think where we land is in this compelling gray area between mathematical efficiency and behavioral inefficiency.
Right. It is the tension between what the market should be on paper and what it actually is when human beings get involved.
For my part, the sheer weight of the empirical evidence demonstrates that the efficient market hypothesis holds true for the vast majority of participants. The speed of high-frequency trading algorithms ensures that new information is priced in before a human can rationally act on it. So, active retail trading based on news is largely a behavioral trap fueled by overconfidence. Passive, long-term asset allocation is really the mathematically rational approach.
And I maintain that perfect market efficiency is a myth disrupted by human emotion. The data on retail markets proves that algorithmic news and regulatory shocks create predictable behavioral contagions. By avoiding emotional traps through rigid discipline, journaling, and using defensive tactics like limit orders, a dedicated retail investor can absolutely exploit these anomalies.
Well, we certainly agree that undisciplined, reactive trading driven by emotion is universally destructive to wealth. The open question is whether maintaining that psychological armor is a realistic endeavor for the everyday investor, or if standard human nature will always leave us vulnerable to the algorithms.
Yeah. The literature on market mechanics and behavioral finance is vast, and technology continues to alter retail participation. There is so much more to explore here. Listeners will have to weigh the statistical probabilities against the behavioral opportunities to form their own conclusion.
Exactly. Thank you for joining us on The Debate. Keep questioning the consensus.